Let's continue our journey. Today we are supposed to create a cash flow statement. Here is our cash flow statement starting point. And as we discussed in the last session, our cash flow requires, because our model does not have a historical cash flow. So we are going to start preparing the cash flow from scratch for the historical years also. And we are going to continue into the projection. And this is a critical calculation for us because this calculation is going to help us in setting up and completing our balance sheet. And also this is going to be our basis for our valuation of the company, because cash flow is the critical element in valuing a business or a company or a investment proposal. I'm not going with 2020. I don't have the numbers for 2020. 2019. The numbers we have are from 2020. So if I go into 2020, that will be starting from zero. And I don't like that approach. So I'm going to start with 2021. And our starting point in cash flow statement in any cash flow situation is our profit after tax. So I'm going to pull this profit after tax for 2021 from the income statement of 2021. And that's the first item in this. Then we have to add to this depreciation. And if there's an amortization, because that is the non-cash expenses, that also I will bring in from P&L. We have depreciation for 2021, and this depreciation is added back. We did discuss in the last session that the modern approach is that interest is part of uh, operating expenses, and it should not be relegated to investing activities. But for this particular uh, uh, exercise, we are going with the classical approach, and we are taking interest as part of investing activities. So if we take interest as part of investing activities, then we did reach at this interest, at net income by deducting interest. So we will add back that interest, and that interest I will bring from again income statement for 2021. And this is where we end our uh, uh, adding back, because there's no amortization and there's no other item here. So this part is done. Now we have to add changes in working capital. Now changes in working capital, it's all clear for us. We did discuss in the previous session how and what is the logic behind this. So add an increase in provisions for employee fund, uh, and add increase in advances from customers, increase in commissions payable, increase in insurance premium, and increase in accounts payables. All these things are uh, basically the liabilities, and these liabilities, any increase in liabilities is to be added, and we will create a formula that will show our addition. If there's an increase, that will be shown as a positive number. These values we are going to pick from our balance sheet. So let's look at the balance sheet. Let me put an is equal to sign. Our balance sheet, first item is provision for employee fund. There's an increase in provision for employee fund. So I'm starting with 2021. Oh, it's a decrease actually. Uh, I will start with 2021, and from this I will deduct the 2020 number. And interestingly, the first number I see is a negative number. Now, this is a very good example to start with, that if there was an increase, that increase has to be added. So vice versa, if there is a decline, that decline has to be deducted. So this formula, if I start with the later value, which is 2021, F9 is 2021, and from which if I deduct E9, that gives me the starting point. And if 2021 number was higher than 2020, we could have automatically got this number plus. And if the 2021 number is smaller than 2020, that means there's a decline. So that should be written as a deduction, and this number automatically becomes minus. I'm going to copy this formula down because I think all the numbers are congruent numbers and there's no increase in insurance premium. Let's check uh, F12 to E12, F12 minus E12. F12 minus E12 increase in, there's no increase, it's exactly the same. Commission payable, I think there is an increase or there is a change. So that change is reflected. Accounts payable, the change is reflected here. So all these numbers are correctly reflected. Now we'll go to the other side of the balance sheet and we'll look at current assets and inventory. An increase in inventory should be reflected by a negative number. So in this case, I'm going to reverse my formula and I'm going to start with uh, uh, the earlier number, and from this I'm going to deduct the later number. You see there's an increase in inventory. So this increase should be reflected by a negative number. This formula basically I was taking earlier number and from later number, and from later number I was deducting the earlier number. And in assets I'm taking the earlier number, 2020 number, and from this number, I'm deducting the 2020 number. And if there is an increase, that is showing as a negative value. And if there will be a decrease, that will be shown as a positive value. All these numbers have increased. So all these values are negative. Let's confirm from the balance sheet. uh, you can see all these numbers are greater than 2020. So this actually shows an increase, all these values, and these values should be reflected as a negative number. So this means I can simply sum these numbers and we will get uh, negative 45 million. That means the company has used 45 million in working capital in 2021. And once we have got the working capital adjustment, we are going to sum these values and we are going to add this value to the sum. I'm going to add a sum function and sum function these values, and I can simply put a comma and refer to this number, and that will be added, and we'll get our cash flow from operating activities. Uh, you might have noticed that I'm entering the numbers only in 2021 because I want to be sure that my working is correct. Only then I will copy the formulas across and go to the 2022 and other years. So first of all, our formula and structuring has to be correct, and that we have to make sure that it is correct. Uh, Next item, this is our cash flow from operating activities. Cash flow from investing activities, we have to deduct capital expenditure and we have to deduct gain from disposal of assets. There is no capital, there is capital expenditure, yes, and there is no gain from disposal of assets. There is no work in process, and there is investment. So increase in investment should be reflected. Now, what I want to do, I want to bring in capex, and capex. I can look at the increase or decrease in assets from the balance sheet. However, we do have an asset schedule, and in this asset schedule, we have the amount of capex. So I'm going to directly pull this value from here, and this is our capex. The value is 0, but look at the starting point of this sentence. It says less capex. So I should start this capex with a negative sign so that the number becomes automatically negative. Although number for 2021 is 0, but my formula should be correct because I'm copying the formula across. and it should pick the number correctly and should reflect the number correctly. Now, gain on disposal of assets, I will again go to pick from asset schedule, and there is no disposal of fixed assets throughout this model, but I'm just going to pick this value from here to complete my formulas. uh, in increase in work in process. Now, work in process also, there is no increase or decrease in work in process because throughout this model, we do not have any capex, sorry, any working capital. So work in process is negative, and it's zero. But I started this reference with a negative sign so that if there is a number in future situations, that should be reflected properly. Uh, Increase in investments, that I will put a formula from my balance sheet, and if there's an increase, that should be reflected by a negative number. So I start with earlier value and I deduct the later value from that. And there's an increase, and that increase is showing as a negative value. And I'll just sum these values, and this gives me the cash flow from investing activities. And actually, uh, up to now, what we find out, the company has generated a cash flow from operations of 130 million, and company has used 13 million in uh, investment activities. Now, the last section is the financing activities. So, new equity raised, I can get it from the balance sheet also. But again, we have this other calculations where we have the new equity raised. We don't have any new equity raised. So this is our starting point. New secured loans raised. This company has not raised any secured loans throughout this model period. So we don't have any secured loans. Actually, we should go to debt schedule. And in debt schedule, we will see there are no secured loans. So this secured loans are zero. Uh, Unsecured loans, company did not generate any unsecured loans also. So let's go to unsecured loans portion, and this is the new issue of unsecured loans. So that also is zero. Then secured loans repaid, because there was no secured loans, so there's no question of repayment. But I will pick these values from this secured loans repayment. Here is the secured loans, and here are the repayments. Repayment is zero, and unsecured loans repayment. Yes, there is a repayment of unsecured loans. So I will pick this value again from the debt schedule. And this is our repayment of unsecured loans. And finally, dividend paid. Interestingly, this company never paid any dividends. So do we have another calculation? Here is the dividend paid. Company did not pay any dividend. So this part will remain zero. And now we will add back the interest, which is which we added up here. We are going to put this as a negative number. So net impact of this interest is going to be zero, but it will become part of our financing activities and not the operating activities. Uh, Now I will bring in this interest. I can pull from P&L, or I can pull this interest from our debt schedule also. So I'm going to pull it from the interest expense schedule, interest expense, and that will give us the total cash generated or used in financing activities. Most of the cash is used in interest and loan repayment. So with this, we have now, we are in a stage where we can find out the total cash, net cash flow for the period, and that is operating cash flow plus the investment cash flow plus the financing cash flow And that is the first part of our cash flow calculation, 33 million. Now, I have no way to find that it is correct or not, but I have some linkage with the balance sheet. I'm preparing 2021 balance sheet, 2021 cash flow. The opening balance of this cash flow, I have a number in the balance sheet and 2020 number of cash and cash equivalents on the balance sheet. I'm going to copy this number. I'll take this as closing balance for 2020, and this closing balance for 2020 is now the opening balance for 2021. We have the net cash flow generated during the year, which we have calculated up here. And now is the time to find out the closing balance of the cash flow. And this closing balance is going to be opening balance plus net cash flow for the year. And that is our total cash outflow. Now, as I keep stressing that throughout the modeling exercise, you should continue to check your work and find out if the work is correct or not. Now, as I said, I'm just entering the formulas for 2021 because I want to first make sure that the values I'm calculating are correct and they are going in the right direction and my model structure and formulas are correct. Now, how can I confirm that this number is correct or not? Can anybody help me with this?
Sir, we can put this number in balance sheet for 2021.
Very good.
Uh,
We actually have this number in the balance sheet for 2021, and all I need to confirm is that this number is matching with my balance sheet number. Because we have the balance sheet for up to 2024, this number is matching with that number. So that means my structuring of the model so far is correct, and it is giving me the correct result. Now I can copy these formulas across until 2024, and I will get the uh, results until 2024, and I will match these numbers with the published numbers for up to 2024, and we will see if all is correct. Then we can confidently copy these numbers across and go to and assume that our future cash flows will also be correct. And the ultimate check would be that if our balance sheet is balanced after these calculations for the projected years, then we can safely assume that the cash flows are correctly done and our model entirely is correctly done. So let's copy the let's check these numbers, and these numbers are 110, 187,248, 433, 187,248, 433, 187,248, 433. So these numbers are correct, guys, and we can safely assume that our model structuring is correct and the numbers are giving us correct result. Now, ultimate test is to copy the formula across until the end of the model period. And once we have the end of the model period, we can then fill in these numbers in our model, and that will tell us if our model matches. That means our cash flows and our total model structuring was correct and logic we were using was correctly applied. So these are our cash flows for the projected periods, cash and cash equivalents. Now we have a balance sheet, and in the balance sheet, this cash and cash equivalents, that is the only place which is left, and our balance sheet is not balancing. So let's link this cell with the values in cash flow, and it balances. Very good. So what does that tell us? That we have done a good job of building this model. All balance sheets match. So our cash flow is done now, guys, and our 5 years historic and 5 years projected cash flows are also completed, and our balance sheet is done, our P&L is done. Any questions or comments on this?
No, sir. The general question, for example, cash from operating activities,
Mhm.
it must be positive, good numbers with us. The first column of the cash flow, and the second two sections from
Yeah.
investment activities and financing. If these numbers are in negative, so it means the company is going to good
Look,
because they are generating cash and they are investing their
yeah,
cash.
actually, you have to understand the total operation of the company. Look, in this situation, company is investing in working capital. Generally, companies invest in working capital in the growth phase when they are in growing stage. And the company is in the growth phase from 2020 to 21 and first 2 3 years. Company is in a growth phase and company has invested 45 million in working capital. So this is the first stage. Company also has invested in 13 million in investments. Although company in 2021 did not invest anything in operating assets, and company only paid back the minimum possible, which is the required installment and the interest for the bank. So the major focus of the company is on working capital increase, and working capital is taking money, and it's taking 45 million for this year. And despite that, the company still has a positive positive operating cash flow, and which is 130 million, which is a healthy number. So depending on the company situation, you'll form your opinion according to the circumstances. In some cases, uh, high working capital, increase in working capital may not be a good thing. If the company is not performing well, if the company is not growing its business and still its working capital is increasing, that is a wrong signal. That signifies that the company is not able to manage its working capital well. But if the company is in a growth phase and working capital is increasing, then that means it's a result of the growth, and the company is not does not have any management issues. That answers your question, Sayed?
Yes, yes, sir. Yes, sir. Clear.
Okay. All right. Now I'll open the next one, and in the next sheet, there is a new problem open for us. Let's see. I think this is version 12. It's already calculated, or why it is like this. Okay. Now in this version 12, what has happened in debt schedule? Already there is a calculation entered here.